Most people think investing is about finding the next Apple, but in 2026, that's not really the problem anymore. The real problem is that millions of people in the United States and Europe are finally earning more money, while quietly becoming financially weaker. A 29-year-old software employee in Texas earns $92,000 a year. A marketing professional in London makes $58,000. A nurse in Germany earns more than her parents ever did. And yet, almost all of them feel behind. Not poor, just permanently stretched. Because after taxes, rent, insurance, subscriptions, car payments, student loans, food delivery, and small lifestyle upgrades, there's barely enough mental energy left to think long-term. And that's exactly why most people buy the wrong stocks. Not because they're unintelligent, because they're psychologically exhausted. In 2026, investing has quietly become entertainment. People don't buy companies anymore. They buy excitement. One AI headline appears online, and suddenly millions of people rush into a stock they barely understand. A stock jumps 40% in 2 weeks. Social media starts calling it the future. Financial influencers begin using words like inevitable and once in a generation. And regular people, already stressed from daily life, don't want to feel left behind again. So they buy late, usually near the top. Not because they studied the business, but because psychologically, humans confuse popularity with safety. If everybody is buying something, our brain assumes the risk must already be gone. But historically, that's often when the risk becomes highest. Look at the average middle-class investor today. Maybe they invest $500 a month. Sounds responsible. But then you look closer. They carry $9,000 in credit card debt at 22% interest. Their car payment is $640 per month. They refinance phones every 2 years, and they're trying to beat the market while losing thousands to lifestyle inflation they barely notice. Here's the uncomfortable math. If someone invests $500 monthly into random hype stocks and earns inconsistent returns, maybe they average 5% annually over time because of bad timing and emotional buying. After 10 years, that becomes roughly $77,000. Sounds decent, but if the same person simply avoided high-interest debt, stayed invested consistently, and bought financially durable businesses instead of trending stories, that outcome changes dramatically. At 10% annual compounded returns, the same $500 monthly becomes over $103,000 in 10 years. That difference, over $25,000, didn't come from intelligence. It came from behavior. That's what most people misunderstand about investing. The stock market is not primarily a knowledge competition anymore. Information is everywhere. The real advantage is emotional stability. Financially intelligent investors in 2026 think differently from average investors. They don't ask, what stock could double this year? They ask, what business will probably still dominate 10 years from now? That changes everything, because the best stocks to buy now are usually not the most exciting ones. They're companies deeply connected to unavoidable human behavior, businesses people continue using during uncertainty, inflation, layoffs, elections, recessions, and technological shifts, companies with pricing power, strong cash flow, real profits, and products integrated into everyday life. That's why many rational long-term investors in 2026 continue focusing on areas like artificial intelligence infrastructure, cloud computing, healthcare technology, energy systems, cybersecurity, and boring but powerful index-based investing. Not because these are trendy, because modern economies increasingly depend on them. For example, companies building AI infrastructure may continue growing quietly for years because every major industry now relies on computing power. Cybersecurity firms benefit because digital threats increase regardless of economic conditions. Healthcare businesses grow because aging populations in America and Europe continue expanding. And broad index funds remain powerful because most professional investors still fail to consistently outperform the market long-term. That last part is important. A financially mature investor understands something emotionally difficult. You do not need extraordinary returns to build meaningful wealth. You need consistency long enough for compounding to matter. But consistency feels boring, and modern financial media is designed to make boring feel wrong. Every week there's a new revolutionary stock, a new fear, a new crisis, a new prediction. Meanwhile, patient investors quietly continue buying strong businesses while most people chase emotional stimulation disguised as financial strategy. And over time, the gap becomes enormous. Not overnight, not magically, just mathematically. Because wealth creation in real life usually looks repetitive, not dramatic. And maybe that's the hardest thing for modern investors to accept. The market rewards patience far more than excitement. especially in 2026. If you enjoyed this kind of calm, reality-based investing perspective, you can subscribe for